Greetings, guys. Welcome to the MattByron.com show. I'm so excited today. We have our great friend Matt Picheny rejoining us. Matt, it is great to see you. How are you?
I'm awesome. How are you, Matt?
I'm doing well, and as
Good.
always, I really appreciate your time, Matt. I know you're a very busy man, and just so honored to have you on our podcast again today. Thank you for your time today.
Oh, it's my pleasure. Thanks for inviting me to be here.
Yeah, and so for our viewers at home who are watching this, give a little background. Matt currently owns over 4,000 apartments and has invested in over 10,000 properties. He's an experienced real estate investor in the multifamily sector. And today our goal is to do sort of a case study. We're going to go through one of the properties that Matt has owned, and we're going to walk you through from deal hunting to the writing the offer and getting under contract and inspections, all the way through the renovations and exiting the property. So very excited today to have this conversation with you, Matt. Thank you so much today.
Oh, yeah, my pleasure. So
Uh,
today we're going to talk
yeah.
about a property that I acquired and went full cycle on, like you just said, in Lawrence, Kansas.
Okay. Yeah, let's go for it.
Okay, so I call the presentation "Sunrises in Kansas," and just a quick disclaimer. This is all educational information. Everyone's personal situation is different. You should talk with attorneys. You should talk with tax consultants to see how all of this works for yourself. But this is not advice. This is just educational info. A little background on me, as you mentioned, Matt. I'm an investor in over 10,000 units. I'm a coach. I teach people how to syndicate deals. I've written a #1 best-selling book called Backstage Guide to Real Estate. And I think I am the only real estate syndicator that has 2 Tony Awards.
That's
I've been
right.
involved in Broadway and, and,
Nice
and
job.
the theater. Thanks. So, yeah, you can read all about me on my website at picheny.com. You can read my bio. But what I do is syndications, real estate syndications. And so, a lot of people don't know what a real estate syndication is. I didn't even know what it was a while ago. And a real estate syndication is really simple. It's just a bunch of people getting together to do a deal, pooling resources, pooling capital, so that they're able to do a deal that maybe they wouldn't be able to do on their own. So something, that would otherwise be unattainable for them. And a lot of things are done through syndication, a lot of real estate deals, but other things as well, including Broadway shows. Most people don't know this, but most Broadway shows are done in a syndication model. So it's another interesting little theater tidbit there for you.
And so, Matt, when you do
Yep.
syndicate a deal, are you
Yeah.
raising money before you find the property or once you've gotten it under
Well,
contract? At
you
what point in
you
time?
you can do it however that you want to do it, right?
Okay.
There's many different ways to skin the cat, so to speak, right? And so
Yeah.
each thing can be done differently. Some people will put together a fund of some sort, and they'll raise capital and then go after deals.
Okay.
What I tend to do personally is I wait until I have an actual deal, and I do it on a deal by deal basis. So I get a deal, I send that out to my investor database. People will choose to invest in it, and then we use that capital, including put my own money in my own deals, including my capital. We put it all together and we acquire those assets.
Okay.
Cool. So the way that mine worked, was my search. This was actually the first deal that I ever did, which I thought would be a fun one to do a little case study on. And I searched, and I was really looking for a multifamily property. I wanted, approximately 100 units or more so that I could have some, you know, uh, economies of scale. And I was basically open to looking anywhere in the United States, and I started looking. Obviously, I needed to focus on markets. The first market I decided to hone in on was Cleveland. I have relatives there. I had flipped some properties in the Cleveland area. So started looking in there and didn't really find anything that really met my criteria. Most of the properties I was finding around there at that time through the connections that I had were smaller properties, like 30 units or so. And I was living at the time I was in Miami, Florida, and it just didn't seem worth it to have something so far away for only 30 units. It just didn't have the economies of scale I was looking for. I wanted something bigger. So then I started looking for something a little closer to home, if you will. As I said, I was living in Miami. I grew up in Orlando and my parents lived in Orlando. And so I was looking in the Central Florida area. and looked at a bunch of things, found some deals. Some of them looked good and interesting and tempting, made some offers, nothing really panned out. And then I started also looking in Kansas City. So while I was still looking in Central Florida, I was looking in Kansas City. And right at this time, I also moved from Miami to Boston, Massachusetts. And so when we moved to Boston, and that's, by the way, how I know Matt. If you didn't watch the earlier
That's right.
last episode, we met on the T train in Boston. Anyway, when I was in Boston, I was looking also in Kansas City. Now, why Kansas City seems like a really strange, random kind of place. I had spent a summer in Kansas City, had a wonderful time, and also had a really good friend who had recently moved there with his family. So I knew someone in the area. He used to be my roommate in college, actually, a really good friend of mine. So I was like, oh, well, worst case, I'll get to go visit him from time to time, and hopefully I can find some deals that make sense. And I started looking at deals, and they started penciling out on paper. And I was like,
Yeah.
oh, this is good. I need to start going, visiting that market and see if I can make something happen. I analyzed over 100 deals between Florida. I mean, if you look at the states in here, you can see Florida, Georgia, Ohio. I mean, I was looking
Wow.
at things and looking at a bunch of different deals, and I analyzed over 100 deals. I started keeping a spreadsheet of them because I was like, how
That's
long is it going
crazy.
to take for me to, finally get a deal? And it was, I believe it was 114. I wrote, there's a whole chapter
Wow.
in my book about this deal, and I have the exact number, but I think it was 114 deals that I looked at and analyzed before
Wow.
I actually ended up getting this wonderful gem right here
And
called.
now, Matt, just for a second here, when
Yeah.
you analyze over 100 deals, at what point in time do you say this deal is not worth it? How many hours do you think you invest in a potential deal before you pull a plug and move on to the next one? What was like your rough amount of time invested per deal for underwriting?
Well, I was just starting off.
Okay.
So the first few deals that I did, I maybe spent, I would say, 8 hours or 4 to 8 hours because I was learning how to do
Wow.
this and,
Wow.
figuring it out.
Yeah.
I am not the kind of guy who goes to the gym and like works out all the time, but when you do, they talk about getting in, repetition, reps, right? And
Right.
you
Right.
get better, and that's how you get stronger. And by underwriting, and this wasn't just deals that came across my desk that I looked at and said, no, these were deals that I actually analyzed. I actually underwrote 100 and, over 100 deals, and
Wow.
I got really good at it.
Yeah.
You do something 100 times that's that complex, you
It's
get good
impressive,
at
Matt.
it.
That's a ton of work.
Yeah, I
Seriously,
mean,
it's a
it was,
ton of work.
over a year, about a year and a half worth of looking
Wow.
at deals and analyzing them. And so I got to the point where I was able to, within, an hour, I would say now I could look at a deal and in about a half an hour, like if I'm starting from scratch,
Yeah.
about a half an hour,
Wow.
probably I can figure out if a deal's gonna looks like it's going in the direction of making sense. Obviously, there's many layers that you need to go in,
Sure.
find something that looks like it makes sense, and you get a little further and it doesn't, or it ends up being better. There's things that come out, but I can usually get a good sense of a deal in about 30 minutes to an hour now.
Okay.
But I've been doing this for, looking at deals since 2016, and
Yeah.
so
Nice.
it's been a while. It's been what, 8 years that I've been analyzing deals and looking at them. So I've gotten fast at it. Yeah. So this was Sunrise Properties. It was actually two complexes that were the sister complexes built by the same builder. It was like less than 5 miles from one another, like a 2-minute drive from one another. So one was called Sunrise Village and the other was called Sunrise Place. So that's why we called the whole deal itself Sunrise Properties. One was 68 units. If I remember correctly, it's this one, the townhomes, that was 68 units, and then the other one was 64 units. So a total of 132 unit complex in Lawrence, Kansas. Now, I was looking in Kansas City. Lawrence is not Kansas City. It's a different MSA. It's about 45 minutes west of Lawrence, of Kansas City. Sorry. Lawrence is about 45 minutes west of Kansas City and about 30 minutes east of Topeka, which is the capital of Kansas. But it's a wonderful, wonderful town. As you can see, there's a lot of accolades about it. And it's probably most well known for having KU there, which if you're into basketball, which I am not, but if you watch college basketball, the Jayhawks are from there, and they won a couple of years ago, the whole March Madness thing. But I did go to a basketball game there. It was amazing. They actually have the original rules of basketball
Really?
inside a wall there. Yeah, and you press a
Wow.
button and it lights up, and it's really cool. One
That's
of their
wild.
alumni
So
who,
now, Matt, in the case of this property here, you underwrote
yep,
over 100 properties before choosing
yep,
this one. Do you
yep.
recall what specifically made this one stand out? What made it jump out in your underwriting?
Yeah, so I have been looking for deals. A property manager that we had in the Kansas City area. So a lot of deals in Lawrence are, owned by and listed by brokers and managed by companies that are based in Kansas City. And so the company that was managing this property was based in Kansas City. I had already met with them and been working with them for a while, looking at deals. They told me, hey, one of our clients is looking to sell one of their properties. Would you, and we think it's going to fit what you're looking for. Would you like me to make an introduction? And I said, yes, please. So they introduced me to the broker who had this deal. And
Okay.
then I underwrote it and the numbers made sense.
Okay.
It was a value add deal where we could go in and make improvements to the property. And the returns looked good. So I said, great. So I started to find out about Lawrence, found
Yeah.
out it was a good town, thought I was interested in it, and then needed to start to negotiate and put in an offer on the property, which I did. I put in an offer. Now,
Yeah.
my offer was lower than what the broker told me they were looking for. If I remember correctly, they were looking for around $12 million. And my underwriting had me in somewhere around $9 million. So
Okay.
I spoke with the broker and I was like, hey, look, like I'm way off on this deal. And I think I felt like I could actually get up to maybe 9.3, maybe 9.5, but I wasn't going to go in with that offer right away. I said, I'm around 9 million. Actually, I think I was a little bit lower than 9 million, but I spoke with a tax consultant, found out some good information, and was able to come back with a little bit of higher. So I came back to her and I told her, I think I told her I was a little under 9 and that I wasn't even going to make an offer. And she said, go ahead and make an
Wow.
offer.
Okay.
Just make an offer. And that's all she said. But it gave me the feeling that like maybe the 12 million was too high and she knew it, right? Because of the
Okay.
way that she was just like, well, just make an offer anyhow. So I was like, all right.
Right.
So I put in the offer at around 9 million and maybe it was 9.1, somewhere right around 9 million. And she came back to me a few weeks later and she said,
Weeks later.
yeah.
Okay.
And she said, sorry, I'd been following up with her and everything. She said, sorry it took so long, but there's 4 owners of the deal and they all do different things. And, they took them a while to get together, but they've decided to pull the property from the market. They're not going to be selling it. And I was like, oh, she's
Wow.
like, yeah, all the offers came in, close to yours. And they just, they were expecting 12 million. So they're not going to sell. And I was like really disappointed because once again, I had looked at hundreds of deals. I had put offers in on several of those deals, and none of them had panned.
Yeah.
Like, oh man, here I am again with another deal. It's not panning out. But
Right.
I wasn't going to take no for an answer.
Yeah.
So, I asked her, I was like, what did I do wrong? No, you did everything right. Everything's good, blah, blah, blah. And I just continued to have a dialogue with the broker for about, I think, a couple of months, going back and
Wow.
forth with her on this deal, why this deal made sense, why they should sell it to me. And at the time, interest rates were going up.
Okay.
And I kept telling her, you need to tell these guys, she's like, they're going to do the value add themselves, because they see what everyone's business plan is. Like, they're going to just do the value add and then sell it for 12 million, which made sense to me because that's what my business plan was like. I'm like, okay, I buy it at 9, I do the value add, I'm going to sell it at 12. Everyone's happy. I would need, $2 to $3 million of equity. I'd sell it for $3 million profit. So I would double everybody's money. Like, everyone would be happy. But if these guys do it, then it doesn't make sense. So I tried to, get her to convince them to sell it to me. And as interest rates were going up, I did a whole analysis that I sent her. I'm like, look, interest rates are going up, so cap rates are going to go up, which means values are going to go down.
Yeah.
So even if they add the value, they're still going to be at around 9 to 10 million anyhow. And then also, who's going to want to buy a property if it's been fully renovated, their buyer pool shrink, whatever. And I mean, this went on for a couple of months, but eventually
Wow.
I bought the property. They sold it to me and I bought it. I got it for 9.9 million. I was
Wow.
able to stretch up some more as I was looking at different things and analyzing different ways to approach the deal. And they were able to come down. And so we bought the property. So there's a picture of me and my business
And
partner.
Matt, just for a second here,
Yeah,
Rebecca,
yeah, go ahead.
talking
Yeah.
about the offer terms, when you made the offer on the property, it took you months to get there. How much money do you put down as earnest money before the inspections, after the inspections? Can you give us a sense of the money down and the duration of time for the
I'm
inspections,
happy to
please?
share that with you, Matt.
Yeah.
And I will in a second, but I just want to caveat it with this. This is not the way that I would approach something today.
Okay.
This worked on this particular deal in this particular market in
Okay.
2018 when we acquired the property, right? So,
Yeah.
so I wouldn't use this as a guideline.
Okay.
Okay, but I'll tell you what we did. We bought the property for $9.9 million. We needed to raise $2.63 million of equity. We got a Fannie Mae loan at 75% loan to cost on the property. And the LOI, the letter of intent that we sent over, if I remember correctly, might have been a 45-day, it was a 30 or 45-day due diligence period. Earnest money, I think, was like around $100,000 to $200,000.
Okay.
And none of it was non-refundable until closing.
Wow.
Very unique. I've done deals where we had to put $1 million down on day one, non-refundable, right? So,
Wow. That's serious.
but this deal with these four guys that weren't really, they had their own businesses that they did. They weren't really professional investors, if you will.
Okay.
And, we were able to get, really favorable terms for us as buyers.
Yeah.
So it was good. I think it was 45-day due diligence period. I think it was 100K earnest money. None of it was refundable. Oh, I think it became non-refundable once our loan was approved by the bank. So if we had never been able to raise all the capital, all the equity that we needed to close the deal, I think we would have lost the earnest money.
Wow.
But other than that, yeah, it was pretty beneficial for us. It was kind of rare, right? To get that. But anyway, here's a photo of us at the right after we signed the LOI, or right after we signed the PSA. The day we were signing the PSA, actually, I think is when this was. And so we did due diligence on the Oh, there's that picture of me on the left. That's me actually signing the PSA.
Wow. Historic moment.
I had a lot more hair on the back of my head back then. So anyway, then we went through every single unit, all 132 units. I walked personally along with the
Wow.
team that we had. So we walked and we took notes. We did everything that you would want to do. We inspected everything. The picture in the center is me and a plumber scoping the drains going from the clean out of the building all the way out to where it connects with the municipal sewer line to make sure there's no break
Nice.
sewer line. On the right, that's a guy taking a look at the electrical panels, make sure all our wiring is copper and not aluminum, and making sure the breaker boxes look good and all that kind of stuff. So we did the full due diligence on the property. Everything looked good. And then we closed on. Oh, and then before we closed on the property, I put together this presentation. This is back when I used to call my company MJP Property Group, and this was the cover page for the presentation that we did for investors. We did a live webinar. I had to raise $2.63 million. and I had no idea how the heck I was going to do that. I had never raised money for a deal before. I'd never had a
Wow.
sales job before. I mean, I worked in digital marketing before, I guess some sort of like marketing stuff, but I was a project manager. I was not a sales guy. So like it was kind of a stretch. I had a partner, you saw a picture of him, Justin, in the other picture. He had done a bunch of these deals before. So
Okay.
um I was relying on him a little bit from an expertise perspective and also from a capital perspective because he had investors that he could bring in. I told him that I thought I'd be able to bring in somewhere between 100,000 to $1 million of capital in the deal because I actually had saved up for a long time. I had $100,000 of my own money that I was putting into the deal. And then I figured I'd at least get some, worst case, at least 100,000, right? But I thought maybe I could
Yeah.
maybe a million on the deal. I end up raising $1.8 million for this deal.
Nice.
Yeah, I was surprised. I had been telling people that I was doing this. People knew that I had been doing real estate as a hobby for many years. I did it for 10 years before I started doing these large scale multifamily deals. And so I think a lot of people just knew me, knew who I was, what I had been doing in business previously, and that this was not like some new idea I just came up with. And also, I had a business partner who had done 10 of these deals, so
Right.
it made sense. And Justin filled in with the rest of the capital, and we closed on the deal, and we got to work.
Wow.
Our plan was to add value, as we said. The first thing that we did was the sidewalk. So the sidewalks were basically reduced to rubble.
Oh, wow.
As you can kind of see, like on the right-hand side of this picture where that walkway, I mean, that's what it was like. And so
Wow.
what we did was we poured this. We did like as soon as we closed on the property, like within a week of closing, we had
Wow.
crews there pouring brand new sidewalk across the whole property because it needed it. And this was them doing, concrete work in progress.
Do you think it's important to to launch a big construction project as soon as you acquire property to kind of like make a statement to the residents?
We did. So we
Okay.
did that, and the other thing that we did was these green improvements. And so we did all of this within, I think, about a month or so of closing on the property. And the reason why was we wanted the residents at the property to know that we were ownership who cared about the property. The previous ownership had owned the property for 12 years
Yeah.
and they hadn't done anything. That's
Oh,
why
wow.
the sidewalks had been reduced to rubble. So
Yeah.
we came in, redid the sidewalks, and got in there, gave everybody new toilets, new shower heads, new aerators for the faucets, and our residents at the property saw their water bills get cut by about a third.
Wow.
So they're like, wow, this new ownership, they came in, they're fixing up the properties, they cut my water bill, they care about what we're doing, they're doing the trouble tickets. They loved
Yeah.
us. They
That's awesome.
absolutely loved us. And it was good for investors because we got a special green loan from Fannie Mae, so we got a slightly lower interest rate, so that helped us out from a financing perspective. It was great for the staff because these are flapperless toilets. So you know how toilets the flapper can break or the
Oh, yeah.
side can break and then they run, and that happens often, especially at
Right.
this property. They were having a lot of problems. And so these were flapperless, so they had less, repair tickets on toilets, if any. And we went from 3.8 gallon per flush to 0.8 gallons per flush. So we were saving
Wow.
50 gallons per flush. So this was great for the environment, right?
Yeah.
So we
Yeah.
were
Seriously.
conserving water, which is good for the world, really good for the residents' bills. We had the lower interest rate, and our maintenance team could focus on other things. I mean, this was I always talk about win-win situations. This was like a win-win-win-win situation. We four ways of winning, and it was wonderful.
That's one of the things I admire, Matt, is that when you go
Yeah.
into these properties, you're often thinking about the resident experience. You're really concerned about their enjoyment, and I respect that. I think there's this stigma to a lot of investors out there that they're just in there for the money, but you sincerely care about your residents and also making money at the same time. So I respect that you're able to balance both those priorities.
Oh, thanks. Thanks. Yeah, I mean, it is important to us. Then we went in, we like trimmed down a bunch of trees. I think you can hear
Nice.
that buzz saw going, but just
Yeah, a little
cleaned up
chainsaw.
the area, did a lot of landscaping work. And so the property looked a lot nicer when we were done. Here you are, new mulch beds, new trees and shrubs, and new concrete. Look at this concrete. It looks
Wow.
full
Looks
all the way
gorgeous.
around. And we put in railing. There was no railing before, and where there was,
Wow.
they had used some piping. It was bad. So we put in this nice cedar railing. It just made the property look nicer overall. Interior improvements. We did new countertops, stainless steel appliances, new paint, nice like two-tone paint here with the baseboards and the
What
doors.
was the biggest
A
surprise
little
for you when you got
different.
into this deal?
Vinyl plank flooring too. So I don't know that there was that many surprises.
Okay, that's great.
But there was just a lot of work. I mean, we knew the property pretty well. We had done some good due diligence on it, so we weren't too shocked with anything. But we went in, we made these improvements, and we were able to increase rents on renewals and upgrades. Right now, like I said, our tenants, were happy that we were spending money on the property and doing stuff. So we had pretty significant rent bumps where by August of that year, we had 28% of the units achieving the pro forma in under a year. And we had you
Nice.
know these rents that went from on the two bedrooms at Sunrise Place starting at 677 average rent at takeover to 755 because we started including
Wow.
the pent rent, or this one here we went from 1037 to 1200, that was not including the pet rent, so we got more. Okay.
Okay.
So that was on the pro forma. So I mean that's almost $200 per unit
That's
upgrade,
great, Matt. Nice job. Yeah.
increase in price. Yeah. So those did really well. The problem that we had was that 74%, almost 75% of the people stayed in the units, even with these increases. If you look, these increases, we're looking at $75 increases. These are the ones that we didn't. When we made an improvement, we were getting $100 to $200 rent bumps, but
Oh,
people were staying in the properties and getting an increase. If you look over here in this column of $100 or more, and
yeah.
staying because it was still the best deal in town. They
Yeah.
were getting, well, they had their water, bills had been cut, and they had all their trouble tickets being taken care of. Everything, the pools were being redone, like so much stuff being redone. They were
Yeah.
like, "Oh, I'm going to stay here," But we had in our business plan that we were going to turn over more units, so we didn't have the
Oh,
cash on
wow.
cash returns that we had expected. But
Oh,
what
I see.
we did have in that first year, which was great, was this cost segregation study. And with the cost segregation study, the 5-year property was about 15% of the total cost of the property. So what happened was, we had a bonus depreciation that year of $2 million, just about $2 million, but the total equity in the deal was just a little over $2 million. So about 76% of the equity was written off as bonus depreciation. So what does that mean? That means an investor who invested in this deal, for sake of round numbers, let's say they put $100,000 in this deal. At
Yeah.
the end of the first year, they get a K1 document, and we were giving distributions, and I'll go into that in a second, but they got a K1 document that showed a $76,000 loss.
Outstanding.
And I've had deals that actually with the bonus depreciation even did better. I had a deal that, you put in $100,000 and your K1 loss was 110,000. It was like you lost more money put into the deal. Now you got to be careful with these things. There's recapture at the end. I've actually got a couple of
Yeah.
videos on my YouTube channel that goes into details on the depreciation and depreciation recapture. But ultimately, overall, it is a really great tax advantage, even with the recapture factored in. of investing in real estate. It's why so many people love to invest in real estate. So we had that awesome bonus depreciation. So that was good. And then eventually we had to sell the property. So the disposition of the property, we went ahead and decided to take a look at what our original projections were, right? So the original pro forma on the property, we were planning to hold it for 5 years. We were looking for an 83% return on investment, which was an IRR of 15.3. And most of the multifamily deals that I'm doing,
Wow.
we're looking for an IRR of somewhere between 14 to 16% generally. That's what our investors like. That IRR takes into account the time value of money. It ends up being, over a 5-year period, somewhere between, 15 to 20% average annual return if you annualize it, right? So this is what we were looking for. And what happened was at the end of July, early August, we had been approached by some brokers to sell the property anyhow, but this was the headline on July 30th on Market Watch. Okay, it was U.S. economy suffers titanic 32.9% plunge in the second quarter, points to a drawn out recovery. Why? Because of COVID, right? And we see a guy in the picture in a hazmat suit cleaning out an airplane, right? Remember, everything shut down for COVID. That was like the middle of March.
Yeah.
So we're only a couple of months into COVID. And the little subline here, the little subheadline, coronavirus triggers steepest recession since World War II. So at this point, remember, there was no vaccines. We didn't know how it was transmitted, right? This guy is wearing a face mask and a mask and a shield and eye goggles and gloves, because back then, I think a lot of people felt that it was being transmitted through touch, not necessarily through breath, right? Nobody knew. Everyone was getting COVID. People were dying. Some people were fine, whatever, but it was just craziness, right? Craziness in the economy, lots of people without work, without jobs, lots of people working remotely. And our tenant base at the property was a lot of people who worked in the service industries, right? So they might work at a restaurant or a bar, or types of jobs where they weren't necessarily able to work remotely. So how long was this going to go out for, right? It says everything points to a drawn out recovery. We didn't really know, but it seemed like maybe it was going to take a while. We didn't know how this was really going to affect real estate. Hindsight now, we know it actually did really well for real estate, but we didn't know that at the time, right? At this time, the treasuries had come down significantly. When we bought the property about 2 years prior, so in August of 2018, we locked in our interest rate at a little over 5%, which was good. And at that time, the Fed was saying that there was going to be more rate hikes, like multiple rate hikes through the remainder of 2018, and at least 2 rate hikes in 2019. That's what they were saying, right? That was their forecast based on the information that they had at that time. But as things went on, I mean, you could see that that's not what happened at all. The rates went up for a little bit. We were actually giving ourselves a little bit of a high five after August when rates continued to go up. We locked in at a great interest rate. But by the end of 2019, rates were slightly lower than the interest rate we locked. And then 2019, it just went down, right? The 10-year treasury is where a lot of the rates are based off of, right? So that's what our note was based on, a 10-year treasury note. We had agency debt on this thing, and the treasury was down almost 2.5%, right? Like it was, the rates were way down. And so when we looked to sell the property and we looked at what our debt was, and we had, like I said, agency debt, so long-term agency debt. That's what I like to get. I still think it's the best kind of debt that's available, that's out there. if it works for your deal. And the issue is that it had a prepayment penalty. It almost
Oh,
always
wow.
certainly does. And our prepayment penalty was a yield maintenance prepayment penalty. So that means basically if the interest rates go down and you want to sell your property, you have to pay the difference between what the rate was and what the rate is now for the
Wow.
remainder of the loan. Because there's an
Wow.
investor, who gives you the money for the, whether it's a bank or a private investor, there's investment behind this, right? There's an investor giving you money. That's your mortgage. And they are calculating and expecting a certain return over a period of time.
Right.
Now, if you give them their money back sooner and when they redeploy their money, they're going to get less of a return because the rates are lower. That's not attractive to them, right? So now if the rates go up, the good news is that there's no prepayment penalty at that point. Now, usually there's an automatic 1% that's already built in, but beyond
Right.
that, if rates had gone up to 10% or something, it wouldn't matter. And actually our note would be very, very sought after.
Now, Matt, I'm curious too with this agency debt for people who are new to multifamily, getting to it
Yeah,
in a big way, the way you
yeah,
are. Is that
yeah.
in any way tied to one's personal credit? So, do they look at your personal credit, or is it more like they look at you and the other co-investors and they say, okay, these guys are qualified based on their experience? How is there some kind of credit determination of that or not?
Yeah, I mean, you'd have to talk with a mortgage broker to get really into the depths of it.
Okay.
But that is your personal credit is not a major concern.
Okay.
Um, Obviously, if I had a bankruptcy or really bad credit,
Yeah.
that would be a red flag.
Okay.
But if I had good credit, I don't know. I mean, not to brag, but I have excellent credit, so
Sure.
I haven't been in that situation, right? But I think great credit and excellent credit is fine. Good credit is probably fine, but if you start getting into the fair or poor credit, the situation it might become more difficult. But the way that these are underwritten is really more focused on the property,
Okay.
and it's a business, right? I mean,
Right.
it's not just you buying a single family house and are you going to be able to make your mortgage payments based on your income, right? It's more like, here's a business, here's what the rents are, here's what the occupancy is. Is this management team capable of running a business like this? Have they run other businesses like this? And if they have, and you have a track record doing it, great. And if you're new, this was something I talked about a little bit earlier. I brought in a partner on the deal, right? So I brought in
Right.
somebody who had done it, and I had actually signed as a KP on another deal with agency debt. It's kind of, I don't want to say it's impossible. And again, you should talk with a mortgage broker who's an expert in this.
Yeah.
But it's not impossible, but it's difficult to get agency debt if you don't already have agency debt. You know,
Okay. So it sounds like in your
so
case, it sounds like you kind of dipped your toes in the water by joining other deals. And then this deal here, you had a partner who had a lot of experience. So that resume helped build your credibility. Am I correct in that kind of
That's
like,
exactly what I was going to
okay.
say, Matt. That's right. I had signed on another loan with another group as a key principal,
Okay.
and had some, a little bit more than of involvement than a passive investor, but was pretty much passive in that deal. And then yes, and then my partner had a experience with a bunch of agency debt, and now I have a lot of experience with agency debt, and so if I'm partnering someone who's newer, right, they'll be able to leverage sort of my resume and my experience as a more experienced person on the team. I think the banks realize that sometimes everyone has to have a first deal, right?
Yeah.
So I think they realize that, but they want to see some strength on the team and strengthen the property. I mean, this was a great property, stabilized property, that had a good track record of doing well and staying stabilized in a stable market. It's not like we were buying something that was only 10% occupied or something like that, right? So it was a sort of a safe bet, I think, for the bank.
Right.
Okay, so the property because the rates had gone down so much, and we had this yield maintenance prepayment penalty. We calculated it, and the prepayment for this property was going to be at that time was going to be 3.4, almost $3.5 million.
Oh, geez. Wow. Holy cow.
Now we had what was it, $2.6 million of equity in this deal, and we weren't even looked to double investors' money at this point. So we didn't have the 3 point. It was a non-starter, right? $3.5 million. The prepayment penalty ate up any profits we would have had. So, we decided that it probably didn't make sense to go ahead and sell it if we had to pay this prepayment penalty. However, this was agency debt. And like I said, I think agency debt is one of the best kinds of debts that you can get. The reason why I talked about rates going up, we just acquired something in 2023, mid 2023, when agency rates were at 6 to 7%, depending on what the deal was, and could be even higher. We locked in. We purchased a property and we assumed the owner's debt. So this agency debt most times can be assumable. So we assumed debt at 3.8% interest in 2020.
That's incredible.
Yeah, it was fantastic. And so that was the same thing with this. Was like, listen, we could, if rates had gone up, we could have sold the property for a lot of money and someone could have assumed our debt. What we looked at was, okay, can we maybe sell this property not at as high of a sale price as we think we could get actually for the property if it was out on the open market? Because if it was out on the open market with someone bringing on new debt, we would have this, $3.5 billion prepayment penalty. But maybe we can take a little bit less if we can find someone who's willing to assume our debt. And again, our debt was just slightly above 5%, roughly 5%. So I think it was like 5.05. So not bad in the big scheme of things. At that time, a lot of deals were selling at between 3 to 4%. A lot of mortgages were 3 to 4%. So it was not great, but we went ahead and we listed the property with a broker, and some offers came in, and
Now, Matt, just for a second here, when you chose
Sure.
to list with a broker, how do you choose the broker? Did you go with the broker who had previously sold it, or did you go with the broker who represented you buying the property? How do you find the broker to represent you? How do you choose them in the sale?
That's a personal decision on
Okay.
how you want to handle it. Well, in this case, we listed it with somebody, not with the person we bought it from. The person we bought it from, I don't know that this person's ever done another deal, not that I'm aware of, in the market. They were not a big broker with a large marketing list. And we had been approached by another broker that I knew that I had looked at deals with, and I looked at a deal literally across the street from one of these properties, and made an offer on it. I really wanted to get it, and that broker got an incredible price for it. And then said, "Hey, I can sell yours too." And so I was like, "Wow, if this guy can, do what he can do, that's interesting." That's when we started looking at it, and the questions were like, why would we go ahead and sell this property, right? We had a property that was performing well. Why are we going to sell it? And there's basically 4 main reasons, right? Number one, there was a considerable amount of value add left in the deal. If I remember correctly, we had renovated, I think at this point, about 60% of the units. So there was still 40% of value add left for a new person to come in, right? Because if I'm going to look at a property, I got a call from a broker earlier this week, and he was like, "Oh yeah, I've got 2 deals I want to tell you about." And the first one, he told me about the first one. He's like, "Oh yeah, they just got done. They renovated all the units, blah, 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 blah." There's nothing left for me to do at that point.
Right.
And I wasn't interested in that. Then he told me about another property they hadn't done anything on. And I was like, okay, that's something I'm interested in, because I can go ahead, add value, force appreciation, not just hope that the market's going to go up, but force that appreciation through making improvements to the property, right? So
Does that mean, Matt, that there's like an optimal level of improvements to make, not to go the full 100%, but to maybe go 50 or 75%? So that way the next buyer
Maybe
has room
depends on
there?
what it depends on what your it depends on what your strategy is, right?
Okay. Yeah.
Your end buyer pool is going to be different. If you have a fully renovated unit, you're going to be selling it to someone who's looking to buy a fully renovated, stabilized asset, right? That's
Right.
a different buyer than me. I'm not looking for that, right? So I'm out of that buyer pool for that particular property. And so the one of the things you really got to think about when you're buying a property is how are you selling it? When are you selling it? What does that exit strategy look like? And hopefully you have a couple of different exit strategies. So at this point, we still had a significant amount of value add left. So that would be attractive and would, I think, make this property interesting to a wide buyer pool. Okay. That was one reason why we might go ahead and sell it, because this was early in the business plan. We were, I think, a little over 2 years at this point. Our business plan, as we just talked about, was 5 years. So
Right.
we're little over 2 years in. So there's still a good amount of value add left. That's going to make it interesting to buyers. There was still a year of interest only left. A lot of times when you buy these properties, you can get
Wow.
a few years where you're only paying interest at the beginning. And on one hand, it doesn't pay down your debt, and you'd love to pay down your debt over time. But during this time, you can have higher cash on cash returns because you're not paying down any principal. This helps you as you're doing renovations on a property and still have some cash flow while you're doing renovations. So we still had 1 year left. If we held on to the property for another year, there would be no interest only remaining, and there would be less value add, right?
And then, Matt, with this property
Yeah.
here, you're talking about an exit after 2 years versus the 5 that you had originally intended with your investors. Behind the scenes, did you have to navigate any challenging conversations with your investors who were concerned about, getting money back faster than they really wanted?
No, and I'll
Okay.
get into that in a second. So,
Okay.
but the reason why it made sense to sell was there's value add left. There's still interest only remaining, and those two things will be gone within a year. And the longer we held on to it, more and more value add we would complete. Right. The other reason why we would sell is because we could do it with the loan assumption. It had to be with the loan assumption, otherwise it wasn't going to make sense. But since we have a loan assumption option there, and also it was going to eliminate risk, right? There was a significant amount of risk at this point because of COVID, and we didn't know what was going to happen. Interest rates could go up. We could have lots of problems with delinquency, and have to, re-tenant the whole there's just a lot of different things that we were worried about. And this property was located in Lawrence, which is a college town. And what's going to go on with education in the next
Right.
year or two? Are people actually going to go away for college, right? All those conversations were happening in July, August, when we were kind of going through this, trying to
Yeah.
figure out what we were going to do. So we then got an offer. And so our offer against our pro forma was interesting, right? On our pro forma, we're very conservative with our exit cap rates. We had underwritten an exit cap rate of 7.5%, which was very, very conservative. Just so that everybody understands, as a cap rate goes up, that means the value goes down. Okay, so if you sell something at a 7.5 cap, you're going to get less for it than if you sold it at a 6.76% cap rate. So the cap rate for the offer was lower than we had projected, which was good. It meant we were getting
Wow.
more value than we had anticipated. Our return on investment, instead of being 83%, was going to be only 49%. However, the hold period, instead of holding it for 5 years, was 2 years.
Yeah, that's
If you
incredible.
take into account the time value of money, it made our IRR, instead of 15.3%, and made it a little over 21.5%.
Wow.
So it was a really very, very attractive IRR.
Right.
So we went to our investors. We did not have to go to our investors. My partner and I could have just made the decision to sell it. And we kind of wanted to sell it. But we also were like, you know what, though? We have 10 years of debt on this. And this was a loan assumption, by the way, so we wouldn't have to pay the crazy prepayment penalty. Do we hold on to this longer? And we were really kind of on the fence about it. There was a lot of pros and cons in both directions. So we decided to poll our investors. So we did an investor webinar, and we had a poll, like an online poll where people could go and vote. And there was one person who wanted us to keep the property. Everybody else, like,
Yeah.
I don't know, 50 other investors or so, said sell.
Okay.
So we sold it.
Nice.
Yeah, so we sold the property. Now it's funny because I'm actually looking at another deal in this market right now. It just came out I told you a broker just called me earlier this week. And so
Yeah.
I pulled up the CoStar report, and I'm looking at exactly what's happened in the Lawrence market since then.
Yeah.
And of course, no one had a crystal ball. What we should have done was we should have held on to it for another year and then
Yeah.
sold it. And I don't think we would have sold it then. And now I think it's worth less, and we'd be able to sell it for less than what we got for it when we sold it. And so I think we made the right decision.
Oh, wow.
It's almost impossible to time the market perfectly, but with a 21.5% IRR, our
Yeah.
investors were really happy.
And I think given the chaos of COVID at that moment in time, I think there's a wise move to remove all the risk and get out of it. COVID was a very wild time back then.
I mean, it was 40% of the timeline. It was 59% of the pro forma return, but it was 141% of our pro forma IRR. It really seemed to make sense for us to go ahead and sell it. So when we looked at everything all together, right, we had 6% was our cash distributions in the first year. It was supposed to be higher in our pro forma, but like I said, we talked about earlier, it was we had a problem with turning over the units because our tenants loved us so much.
That's right.
But by year two, we were turning over the units, and we gave our investors a cash distribution of 11.5% that year. And then at the sale, we sent them a check of 127.5% of their initial distribution.
Wow.
So like if you had invested $100,000 in this deal, you got $6,000 year one. Year two, you got 11,500. And then a couple months later, at the sale, you got a check for 127,500.
That's incredible. So Matt, after you sent those checks out, did you have people knocking on your door begging to give you money and invest with you?
No. But then after we wound down the property, right, about 3 or 4, well, no, I think it was about 6 months after. It takes a little while. We have to hold a little bit of money, make sure everything, all the bills are paid and everything. We sent out another, $4,000 check to someone who put in $100,000. Our investors were really happy. We did have a lot of people say, yes, please let me know when you have your next deal. A lot of the people who invested in this deal have invested in every single deal I've done since.
Wow.
I've been able to repeat. Actually, this was the worst performing deal that I've had in terms of deals that we've gone full cycle on. We had another deal that did even better, and then we had another deal that was a home run where we almost doubled investors' money in 2 years. But I mean, just keep in mind when we were buying these properties, though, right? I'm talking about properties that we acquired between 2018 and 2020 that we sold, in between 2020 and early 2022. If you were buying properties at those times, you had some tremendous tailwinds behind you. Once you got into the end of 2022, once you got into early 2023, I mean, you had these headwinds of running up against you with these interest rates going up, meaning people could pay a lot less for the properties. So, we had we buy great properties in good areas, usually in areas that are on an upswing, if our calculations are correct, and we manage them exceptionally well.
Yeah.
I can't take credit for the market. You know what I mean? I can't take credit for the market. That's why I showed you that we had underwritten the deal to sell at a 7.5 cap rate, because I wasn't banking on the market to do exceptionally well, which it did.
And now, Matt, if we can dive into the sale a little bit, I'm curious about the details on the brokerage side. When you listed the property, what was the brokerage commission that you paid to the listing agent? on that, if you know that.
You know, honestly, Matt, I'm sorry I don't remember, but
Okay. No,
and
just
I don't know
curious.
if I, even if I knew, I don't know if I should disclose that because
Okay.
that's a
Okay.
negotiation between us and the broker. But I
That's
think
fine.
that you're trying to get some understanding of what
Right.
things like that might look like. And I'm happy to share that information with you.
Okay.
Um, so broker commissions on these large commercial transactions are not like you're going to see in a resident, right? Residential, they're going to
That's what
get,
I'm talking about.
there's going to be like a 5 or 6% commission. When we're talking about these large multifamily apartment deals, most times, a majority of the times, there is no buyer broker. There can be,
Okay.
but a lot of times there's no buyer broker. There's just one broker. That's the seller's broker. And they'll negotiate a commission, but the
Okay.
commission is going to be a lot. These are much, much larger numbers. So the
Right.
commissions are going to be a lot smaller. They might be a flat fee
Yeah.
of a couple $100,000. They
Okay.
might be, 1% of the sales price or, 0.8% of the sales price or one and a
Yeah,
half
that's
percent
that's
of the
helpful.
sales
Just trying to get
price.
a sense of that. Yeah.
And then a lot of times what they'll do is they'll build in, at least this is what we do, we build an incentive structure.
Okay.
So, hey, the broker says they can sell it for, you know, $20 million. So we'll give them 1% of the sales price up to the 20 million. And then for every amount above the 20 million, we'll give them 10%.
It sounds like the theme here is that everything's negotiable and that you can be creative. Is that kind of fair to say in structuring deals overall in commercial real estate, you think? Like to be
I
creative?
think that's true anywhere, right? If you're selling
Yeah.
your property, your residential property, you can make
Yeah.
deals with your with whoever that agent is. Now, obviously, they may work for a franchise or a large, a
Right.
larger entity, and they may have certain rules and guidelines, but that's all up to you and how you want to handle it. So yeah, I mean, everything's always negotiable.
And I'm curious too, when you're looking at offers for the property, did you sort of vet the buyers and say, okay, this person has closed on other properties that are similar and therefore they're a credible buyer, or it's just the money? Like, can you give us a sense of how you selected the offer that you did choose for when
Sure.
you
Well,
exited?
those are all considerations
Yeah.
that we have on any property if we're looking to sell. Is you know obviously we want to know what the price is because that's we have a fiduciary obligation to our investors to get the highest price. But
Right.
sometimes it might make sense to sell it not for the highest price if there's another price that's a little bit lower, but like you're saying, there's a little more assurity of close, right?
Right.
If you have somebody who's never done a transaction before, it might fall. I'll give you an example. We have a property that we were going to sell, that we had to put into contract in 2023, and with a reputable buyer, by
Okay.
the way, with a reputable buyer that a lot of people know and had a good track record and good reputation. And they had problems. They had problems as a lot of people did, right? In raising the equity to actually be able to close the deal. They extended the deal and then extended and ran out of the contractual extensions and then kept extending beyond there. And we would negotiate with them and get additional deposits put in and allow them more time because it's in our best interest to close the deal. And ultimately they like totally ghosted us.
Oh wow.
And that was right before Thanksgiving. And so here we are recording this now in mid-January. We haven't heard from them. We're
Oh
assuming
geez.
we're assuming they're not buying it, but the market the interest rates have continued to go up. And if we were to put it back on the market right now,
Yeah.
we wouldn't get, I don't think, the number that this person had offered us, right?
Okay.
Because of the way that the market has gone. So now we're not able to sell. Now it turns out to be actually really good for us, and I'll explain why in a second. But if we really did need or want to sell, then the problem is we just wasted all this time and the market has changed, right? The market has shifted and not in our favor. So
Okay.
if we would have had two competing offers, let's say that on this deal that we sold or that we put in contract to sell, but one was a little bit less, but a lot more shorty of close, it would have made sense for us to go with that one if they would have closed. You know what I mean?
Right.
This one now,
Right.
it didn't close. Now we're stuck with the property. Turns out to be great. The property's cash flowing really well. We're happy to hold on to it.
Yeah.
I think we'll end up selling it in about 2 years and make way better profits than we would have. But
Okay.
for a number of reasons, it did make sense. Someone offered us a very nice price at the time, and it would have been a nice sale. So
It-
yeah, go ahead.
And now, Matt, it looks like most of your properties you buy, I think, after this first property and going forward, most of them were garden style properties. Is there a reason for that?
Not really.
Okay.
I know someone who's a syndicator out there who's
Yeah.
who's like well known, who's like, I will never buy a building with an elevator in it.
Okay.
I never got to talk with them. Next time I see them, I want to drill down on exactly why, but I imagine they must have had a problem or heard horror stories about elevators, right? They get inspected
Yeah.
every year and things like that. But we're building a mid-rise right now, a 9-story
That's right.
property in
Yeah.
Canada, and that's brand new construction. That's gonna have a couple of elevators in it. So that's it's not that I shy away from them. It's just when we look out there, what's in the market, what's
Yeah.
available, what is the pricing, what can we add value on? The things that we found have been these garden style apartments.
And as you look back at this first deal here, what would be the biggest surprise to you, the biggest thing you learned from this that maybe like a piece of advice you could give people looking to get into these big, 50, 100 unit buildings, something to avoid, something to watch out for? What was the biggest lesson you learned from this?
Well, I'm hoping that people got a ton of lessons from this whole presentation, and to
Yeah.
try to boil it down to one thing is
Yeah.
difficult. I would try to learn as much as you can. Try to get educated as a passive investor or as an active investor. Education is really important, and then partnering with other people and actually getting in there and doing deals, right? You learn a lot. I mean, look at all the things that I shared with you that I learned
Yeah.
along
Thank
this
you.
particular journey. And every time I'm doing a deal, I learn things. Now that I've done a lot of them, I learn less. But I think I learned something new from every deal. I think you should always be learning in life anyhow, right? I'm always taking classes or joining this, mastermind group or going to this seminar. It's important to constantly.
I think that's part of the fun, right? Is the learning this process and growing, like going from getting into bigger and bigger deals going forward. I think it's probably fun for you, I imagine.
Oh yeah, I really, really enjoy what I do. It's a lot of fun.
That's awesome. And Matt, definitely looks like your website here is picheny.com for
Yeah.
people looking to contact you. As far as deals and us helping you, what kind of deals are you looking for right now?
It really just depends. I'm squarely focused in multifamily, right?
Okay.
And I'm looking at larger apartment complexes, 100 units or more. But we have a smaller property that we're looking at. I coach people. I have a mentorship program, and so there's a smaller unit count property that did come across my desk that is very interesting and looks very promising, and so I've passed that on to my students. So I guess if there was something that was an interesting deal, I'd be open to always taking a look at it, but usually it's not going to make sense unless it's a larger scale property.
Okay. Excellent. Matt, really appreciate your time today for sharing all these tips with us. I think it's been a great video. Thank you so much. And I'll be in touch. We appreciate your time today.
Yeah, I'd love to just invite all of your investors to check out picheny.com because there's tons of free resources there, educational videos, downloads, just a ton of stuff. So just head on over to the website and grab a bunch of free resources.
Excellent. Thanks, Matt. We'll see you.